Welcome to Manage Your Damn Money with Ben and Malcolm, where we trade in personal finance advice for entertaining conversations about money and millennials. Welcome, world, to yet another episode of our favorite show about money, Manage Your Damn Money with Ben and Malcolm. I am joined here by my co-host, licensed financial advisor and certified financial planner, Mr. Malcolm Etheridge. What's going on, sir?
I'm good, man. Thank you for getting all those credentials in the intro. You saved me from having to pat myself on the back later.
Indeed. I always do. How's everything going?
I'm good, man. It occurred to me as I was coming here that it's really interesting how the right song at the right time can completely change your day.
Okay.
So I'm dead tired. I got up since before 5 o'clock this morning. And so by the time we get to the point that I'm leaving my office to come record this show, I can barely keep my eyes open.
Right.
Then all of a sudden, I'm listening to Spotify, Lil Wayne, Stunting Like My Daddy comes on, takes me back to a better place, completely changed my mood.
Different time.
Totally different time.
Indeed. Well,
it's amazing to me.
That's funny. On a completely unrelated note, I had a really interesting experience recently. My wife and I, we came to the conclusion that we finally had to get into the nitty-gritty details of we got to start financial planning with the specifics of what we're spending to run our household. And I can't do that because when I see expenses doing more than I want it to do, I get anxiety and I kind of shut down.
You're like those monkeys with their hands over their eyes.
Exactly. I'm like, no, I don't want to look. So she actually did it. She went through our credit card statements and literally wrote down every single.
Good for her.
I mean, get you a great
You're
wife.
sitting here on a show called Manage Your Damn Money.
Hey, man, listen.
And you got to call for reinforcements and have your wife start doing the digging.
They say 2 is better than 1.
You say that. That is true.
Indeed. But she went through everything. She put it together. She analyzed our spending and was like, okay, this is what it is. And this is what we have to do.
I'm proud of her.
She did an excellent job. So I just want to sing her praises real quick for helping somebody who really is kind of scared at looking at the details. Because I'm like,
It's like stepping on the scale after Thanksgiving.
Oh, man. That's exactly what it is.
You already know what it's going to be.
You know it's going to be bad.
You just have to face the music.
She faced the music for us. And then we have a good plan that we're going to execute for the rest of the year. I'm going to be on a serious budget.
No new Nikes.
I'm out the Nike game.
No new ASOS.
No new nothing. I can barely buy myself lunch at work.
I'm going to hold you to that.
Listen, watch. I'm going to do it
too. You accidentally just got yourself an accountability partner.
Indeed. Well, I want to let people know that on this episode of Manage Your Damn Money, we have a very interesting conversation at hand. It is the emergence of the Fintech industry and how it's helping consumers. But before we get into that, as we do on every show, it is now time for headlines. Kamala Harris says credit scores should include rent, cell phones, and utilities. This was a July 2019 piece on MarketWatch.com by Jacob Passy. Senator Kamala Harris wants to add more data to how credit bureaus calculate credit scores. The Democratic presidential candidate from California unveiled her plan last week during an appearance at the Essence Festival in New Orleans. Harris called for amending the Fair Credit Report Act to require credit reporting agencies to include payments of rent, cell phone bills, and utilities when calculating credit scores. There are an estimated 26 million people who are quote-unquote credit invisible, another 19 million who are said to have quote-unquote unscorable files. According to the Consumer Financial Protection Bureau, these people don't have enough bank or credit union accounts to have a credit score by today's standards. And while the traditional FICO score, named after Fair Isaacs Corporation, FICO, is mainly considered payments on debt such as credit cards, mortgages, and auto loans, the credit score has always been designed to consider telecommunications and utilities payments since they were first released in 1989. And this was somebody quoted in the piece. Legislation to amend the Fair Credit Report Act has already received bipartisan support. A bill introduced in 2017 by former House of Representatives Keith Ellison and a Democrat from Minnesota that require the additional data in the credit scoring managed to pass the House of Representatives. The Senate version of the bill, which was authored by Senator Tim Scott, a Republican from South Carolina, attracted both Democratic and Republican co-sponsors. So Malcolm, how does the concept of adding these more lower tier, not necessarily credit, but still things that you're obligated to pay, into the mix of your credit scoring?
So you know what? You and I had a disagreement about this initially.
Indeed we did.
Because I was 100% pro.
Right.
I was like, Kamala, you go, girl. Look at you.
Right.
And then, so the reason I said that first is because I was like, good, you're allowing people to play ball.
Right.
That wouldn't have been allowed before. Like, I put myself in those shoes, my 24-year-old self, moving out of my folks' house when I got back here from school, getting an apartment, all those rent payments I made on my own,
right.
on time for the most part, all that good stuff.
That could have contributed to your credit score.
And I'm like, that could have contributed. Those payments to Pepco, the payments to my phone company, all that good stuff, it should have contributed and helped me get a stronger credit score initially.
Right.
Then I kept thinking.
Right.
And it occurred to me that America has a debt problem.
Right.
A debt addiction.
A
debt crisis.
Right.
Like, America as a country is in debt to its eyeballs.
Right.
Like, you keep hearing about this debt ceiling that keeps getting moved and moved and moved. We have a serious borrowing problem.
Okay.
Buy now, pay later.
Right.
That's like America's thing. And so essentially what you're doing is just bringing in a whole different generation of folks who otherwise would have been left out until they got to about 27, 28 and really had a chance to build up a few years of other credit history.
Okay.
We're inviting them to the party earlier. That's like bringing your underage cousin to a drinking party at 19 instead of 21, or selling those little Juul cigarettes to kids who are 12 instead of making them wait to 18 to buy tobacco products like most people have to do.
Right.
That creates a whole other problem where really you're just creating more customers. You're not creating a solution to anything.
My issue with it immediately when I saw it was, there's no way I'm giving my social security number to someone who I'm renting.
They already got it.
But
man.
I mean, no, that's not true, because I think there's an assumption made, specifically the renting thing, because all kinds of people who rent, everything from like major corporations down to like mom and pop who are renting out their basement. So does that mean I'm now giving them my social security number so they can report my payment history to whoever so that it gets credited to my credit score?
So there's actually services out there right now that you can subscribe for that will take in that payment information. You do have to give them your social, and they report it to the FICO people.
My only point is that you're adding more vulnerabilities to.
We're already vulnerable.
You keep saying that. The goal is to reduce vulnerability by not necessarily sharing that information.
It's too late.
All right. Well, Malcolm's telling me I'm wrong.
No, you could be absolutely right. This is one man's opinion. And my opinion is just that it's too late for concern. We're already in it. Like all the people who were doing the Face App challenge and wanted to see themselves as 70-year-olds and whatever, just giving data away to the Russians. Like now it's too late.
Right.
You can't get it back. It's already out there. The same way when I applied for my very first credit card and gave the FICO people my social security number. From that point on, I was doomed. So it's too late.
My concern is more so that mom and pop get my social security card or my social security number taken in some other way that's not the more traditional means.
Sure. But Equifax couldn't save you. So, I mean, what are you saying?
And there we go. I might as well just publish my social on the internet just for everybody to see it.
Or text it to me. I mean, start there.
Indeed. And another question before we go to our first music break. Do we really need to add more items to a list requiring what's the benefit of adding these extra things to the things that get credit scored versus not? Like if we keep it how it is versus adding these.
I mean, the big benefit is if I'm a person who never buys a car, I'll never get the advantage of having that car payment history on my credit score, and that's 5 or 6 years of good on-time payment history.
Right.
If I'm gonna Uber for the rest of my life, I'll never get that.
Right.
Or if I'm never gonna buy a house, I'm only ever gonna rent for 50 years, I'll never get credit for that. So I really don't exist. And if I'm a person who's blessed enough to not have student loans, I'll never have a credit file.
Right.
So if I do then need to go borrow money for something to start a business, let's say, or whatever, I won't have the opportunity to because I didn't get that traditional credit file for borrowing for those things that, people did ahead of me.
Well, we look forward to, during this presidential campaign season, analyzing and looking at all the different proposals of the Democratic.
You look forward to it. I can't wait till it's over.
It's just a lot of it's just news headline grabbing. I have this proposal, interesting to talk about. But I'll remind you that you can listen to past episodes of Manage Your Damn Money on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify, and of course, plenty of other podcast platforms. Simply search Manage Your Damn Money. If you don't see us there, let us know so we can solve that problem. And of course, please leave us a review on any of those platforms. That helps more people catch our show. If you have a question for us, send us to us, info@manageyourdamnmoney.com. You can always catch us on social media. My handle is @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
And of course, you can catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm, where the conversation at hand for this episode is the emergence of the fintech industry and how it's helping consumers. On Manage Your Damn Money, we always try to bring you emerging trends in the personal finance space, and this topic is one we've not touched in a while. What do you do when you need help with managing your money, but can't afford or don't want to pay for an expensive advisor like Malcolm? Fortunately, there is an industry that tries to address this very question. We call it Fintech, financial technology, or Fintech as it's called. It's used to describe new tech that seeks to improve and automate the delivery and use of financial services. At its core, Fintech is utilized to help companies, business owners, and consumers better manage their financial operations, processes, and lives by utilizing specialized software and algorithms that are used on computers and increasingly now smartphones, Malcolm, and that's given to us by Investopedia. A piece that we pulled for this particular piece, a quick take on Fintech. This was a November 2018 piece on Bloomberg by Edward Robinson and Julie Verage. Not so long ago, home buyers, entrepreneurs, and investors went hat in hand to the bank to apply for a mortgage, small business credit line, or brokerage account. Financial technology, or Fintech, is rapidly changing all of that by making it easier to save, borrow, and invest online or with a mobile device without ever dealing with the traditional bank, Malcolm. Fintech has unsettled just about every corner of global finance. Traditional bankers at first scoffed when I don't even know what that word is, somebody promised to reinvest their business. Then services such as Venmo, the person-to-person money transfer app owned by PayPal Holdings Inc., started displacing established bank products, so big banks are now joining the revolution. Malcolm, you're in the financial industry. What's the view of Fintech, so to speak, just broadly as an industry or a subset of the personal finance industry?
So interestingly enough, scoffed is the absolute perfect word that you used. When I first started in this business, it was 2011, so we were not too far removed from the financial crisis.
Right.
We were also not too far removed from the folks that caused the financial crisis, absolving themselves from any blame and saying, it was your fault for taking the loan, you didn't have to sign up for it.
Right.
So everybody looked at it and said, good luck, kids. It
Right.
was the whole Occupy Wall Street movement at the time, the folks who were shouting about how the banks were ruining our lives and all that kind of stuff.
I remember that.
And then out of that came all these different payment systems, like PayPal showed up, all these disruptors that people just laughed at and said, good luck, kids.
Right.
Like Silicon Valley doesn't know anything about managing money.
Right.
And then all of a sudden you fast forward to like 2014, 15, 16, and it was like, oh shoot, they're serious.
Right.
Like they're raising millions of gazillions of fulfillions of dollars.
Right.
And I have to take them seriously now.
Right.
And the answer to I have to take them seriously has really been, I'll just buy them.
Right. Indeed. And the story went on to say financial services largely fended off Silicon Valley until around 2008, like Malcolm said, when the global financial crisis caused big banks and money managers to lose consumers' trust. At the same time, fintech entrepreneurs found a welcome reception among millennials like us. Free software and cloud computing also made it easier than ever to launch a tech company. Soon enough, fintech newcomers were everywhere, though mostly in California, New York, Berlin, Shanghai, and London, to name a few. Fintech companies are getting a lot of attention, but they're not about to replace Wall Street stalwarts, says the story. PayPal, fintech granddaddy, only joined the ranks of the global financial powerhouses apparently in early 2018, 20 years after its founding when it cracked $100 million in stock market value. Some startups have struggled after early missteps. One example is Lending Club Corp, a peer-to-peer lender whose founder was ousted after an internal review uncovered conflicts of interest and abuses involving loan sales. So Malcolm, as a millennial financial advisor, what's been your experience of the evolution of the fintech space over the last decade or so?
So also you left out of there as a failed computer engineering major attempter.
I did not know that about you.
I am like extremely fascinated and like enthralled by the world of fintech.
Okay.
And there's just way too many things out there to even like get them all in one show.
Absolutely.
But there's like payments, you've got robo financial advice, you've got budgeting, you've got account aggregation, you've got all these different things out there that are designed to help make your financial life easier, so they say.
Right.
You do have to be worried. You know, I'm always the doom and gloom after we get through what's the good side. I've got to give you the downside.
Absolutely.
All of that data is worth something to somebody.
Absolutely.
That's my concern.
Okay.
But I am extremely excited about what fintech can do. I think in this month we're in right now, I have demoed 4 different types of planning software from folks who they created it in the last year. They wanted to sell me a subscription. And I was like, I've got an hour, let's talk. And I want to see the demo of how all the bells and whistles work together. And I get super excited about it if you can't tell.
So what problems are these fintech companies solving that larger banking institutions are not?
Well, the biggest problem with the larger banking institutions, and mind you, I'm biased, having worked for two of the 4 largest ones in the world in the not so distant past, they take forever to do anything good. Forever.
You're not saying it right. You gotta say forever. Forever. Do you know where that's from?
No idea.
Oh my gosh, you had no childhood. Forever.
I got the Dennis the Menace reference in one of our previous shows.
Go watch The Sandlot, please. But anyways, continue.
I did see The Sandlot. Didn't find it all that great like the rest of America did.
Gosh.
Anyway.
Get out of here. Go ahead. Continue. Whatever point you're about to make.
So the real you completely threw me off with that one, by the way.
Well, never mind. Let's just move on. Charles Schwab launches subscription-based financial planning models to attract younger clients. This was some information we pulled from the Los Angeles Times as well as financialplanning.com. Charles Schwab Corp, Charles Schwab Corp, the low-cost investing pioneer that now handles more than $3.5 trillion in assets, is switching to a subscription-based financial planning option to its digital advisory service that offers more hands-on help. A high percentage of Schwab's new robo clients are millennials, according to a person quoted in the story. The average account size is now around between $300,000 to $400,000, and that's on their robo advisory piece. Does that surprise you, Malcolm, that much is being held on a robo advisory service?
It does and it doesn't. The data is a little bit skewed in the sense that it doesn't always incorporate where the money came from.
Okay.
And so you'll see things like we're the generation who is set to inherit, however the number plays out, some trillions of numbers of assets from our parents.
Right.
over the course of like the next 20 years. That has already started to come to fruition.
Right.
And so some or a lot of what you're seeing in those larger numbers, not that people out there aren't good savers, some of them,
right,
but you're seeing in those numbers is folks who are inheriting large sums of money in their 30s that are skewing those numbers a
and
little
moving the money into a different place, which would be these robo.
Oh yeah, they're moving the money away from mom and dad and grandma and grandpa's traditional broker who called them and sold them a stock or two every now and then, and you know, that was that.
Right.
They're moving away from those people as fast as they possibly can.
Right. Random question for you that I just came up with here live on the spot.
Uh-oh.
What's the implications for your profession when you have this kind of blending? I mean, I could see a product like robo investing advisory service being of use to you because that makes your job easier. Then what's your role?
I appreciate you giving me the opportunity for that commercial there, brother.
Well, go ahead.
So essentially what happens
is
the beauty of being me is that I'm wedged in between. I'm like a cyborg. I'm wedged in between the technology and the people because I am not a digital native. My kids, your kids are digital natives. Like they're gonna grow up in a world where they can't imagine that paper even does things.
Right.
However, I grew up analog and adjusted to digital. So I'm like a digital immigrant. I'm not a digital native. So for me, the beauty is I know how to use all of those tools to make my job run faster and make the investment process smoother and easier and all that kind of stuff. And I can focus 100% almost of my attention with the clients on the advice. The advice you can't necessarily replicate in a way that the folks that you're talking about who haven't gravitated to technology and learned how to use it in a meaningful way, they're gonna be left or already being left behind in ways that like they don't even know are happening until it's already happened.
Certainly. And I want to let you guys know that we actually have a guest for this episode. He goes by the name of Calvin Williams Jr. He's the founder of a company called Freeman Capital. We're going to be talking to him on the other side of this music break. And he's going to tell us about his platform that he's building or has built. And it's a fintech product, so he'll give us some inside baseball of how the fintech space works. But I want to first remind you that you can always catch past episodes of Manager Damn Money on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify, and anywhere else where you might listen to podcasts. If you don't see us there, send us a note at info@managerdamnmoney.com and let us know so we can get the show there. Of course, please leave us a review on any of those platforms. That helps more people catch the show. And you can always catch us on social media. My handle's at MYDM1. Malcolm, how about you?
At Malcolm on Money.
And that's on Twitter and on Instagram and on Facebook. Please join our Facebook group, facebook.com/groups/Manager Damn Money, where you can talk to people and continue the conversation we have here on a weekly basis. This is MYDM with Ben and Malcolm. We will be right back. welcome back to Manage Your Damn Money with Ben and Malcolm, where today's conversation at hand, we're discussing the emergence of the fintech industry and how it's helping consumers. And I'm happy to welcome to the show Mr. Calvin Williams Jr. He is the founder of Freeman Capital. Freeman Capital is a forthcoming SEC-registered automated wealth management platform that provides financial planning through artificial intelligence, or AI, automated investment management, and online education. Through the platform will be launching soon and available to anyone soon. So we're going to hear about that. Calvin, welcome to the show, sir. How are you?
Thank you all for having me. I'm feeling great.
Absolutely.
Sure, man. Thank you for being here. And actually, Mr. Carter, can I point something out to you before we get too deep into this part of the show?
Go ahead.
This is a first for us. Would you like to know what it's our first of?
I'm listening.
This is the very first time we've had a guest on the show who is a fellow Aggie.
Huh?
I just want to get that in there and make sure that it's on the record.
Okay.
Continue.
Are you done?
As you were.
Okay. Full disclosure, ladies and gentlemen, Malcolm Etheridge is an investor in Freeman Capital, so we want to make sure we let you know that at the front end. So first of all, Calvin, please tell us about yourself and what drove you to enter the fintech space.
Yeah, so I've always been around technology my whole life. I mean, even as a kid, I can remember like being up in my room, kind of building software, and then I was fortunate enough to begin working as a computer scientist at the age of 17 at the Department of Defense.
Okay, wow.
And so I, of course, went to North Carolina A&T.
You had an adult job at 17?
Well, it was through the college.
Okay,
you get like a co-op. So
Okay.
I was there for about every single summer.
Okay.
And so it was just really cool just to kind of get that experience early on. And then after I graduated from there, I realized that although the mission was great, I wanted to kind of continue my own entrepreneurial endeavors. So I formed my first company, which was called XMG Online, and we built web applications for the government, for brands, and all types of things. And then I got tired of that, and I wanted to sell it, and I sold it to my partner. Okay. But I thought I had some money until I went and talked to someone like Malcolm, who quickly said that if I couldn't write them a check for $250,000,
right,
I couldn't even talk on the phone.
Right.
And to me, that was the problem that really triggered this whole thing about Freeman Capital.
Ah, I see. So that was where you saw the window in the space.
Yeah.
So tell me about your experience broadly, kind of Freeman Capital aside for the moment.
Yeah.
What's been your experience of the development of the fintech industry overall?
So I think that we are entering kind of the third wave of financial technology. The first wave were our products like Mint, which were great in just bringing your accounts together, and they did some automatic budgeting and just kind of the kind of intro level, right?
Right.
And then you had the second wave of financial tech, which was finding ways to make services a bit cheaper, to like bring a few more people that already had means to just kind of help them out, right? But now in this third wave, it really is about access, about finding ways to take technology to make financial products easier and more open for everyone to have.
Okay. Malcolm, I mentioned in the show you're an investor in Freeman Capital. How did you two hook up? What's the story behind that?
So I mentioned that Calvin is a fellow Aggie. Aggie born, Aggie bred.
Continue.
So actually, ironically, I happened to be taking my CFP exam in 2018.
What is that?
My certified financial planner exam in 2018, which basically in layman's terms just means I'm kind of a big deal in this space now. That's it. But anyway, you keep setting it up, so I have to
So humble,
I have to knock it
The
out.
most humble person I know. Continue.
I
sir.
am. I'm probably the most humble person you've ever met in your life.
Uh-huh.
So anyway, I posted on LinkedIn actually that just passed my CFP exam. Calvin and I are connected on LinkedIn because we're classmates, and he's like, dude, I'm actually looking for a CFP right now for this project that I'm working on because essentially I don't trust anybody to work on it who doesn't actually have the credential because then you're not official.
I see.
So serendipitous timing more than anything.
Exactly.
Excellent. So what problem specifically, now going into your product specifically, what problem are you looking to solve with Freeman Capital?
So the biggest thing that we are focused on is finding ways to close the wealth gap. I mean, progress has been made where you have people of color, you have overlooked populations who are starting to earn more money, but when it comes to building wealth, there's like a major gap there. And from our perspective, that gap does have some systemic issues, but it also comes down to a lack of access, a lack of education, and a lack of tools. And so that's what Freeman Capital is trying to do.
Okay. So why now, though? Is there a specific reason why? Because you said we had the first 2 waves.
Yes.
We're in the 3rd wave. Is there a reason specifically why you just looked up one day and said, I can do that?
So I think that, one, I'm part crazy enough to think that I could do it, and then 2, finding teams like, and folks that like you that are passionate about it, that's, one thing. But when you already have, these industry leaders who go out and they kind of break this new framework of providing a service in terms of fintech, and they kind of give you a platform to stand on, right? But when you then look and see, like, they're not really focusing on their problems at hand. Like, a lot of the fintech players, like you all had previously mentioned in terms of Charles Schwab, they are finding ways to keep money that they are trying not to lose. Right. They're not trying to bring in new investors, brand new populations, which have been overlooked and that are being ignored. And that is the true opportunity that this 3rd wave is in.
Okay. So you have a software engineering background.
Yeah.
How do you even start to begin to build something that's AI or artificial intelligence? Right. What does that mean for people?
Yeah, so AI can mean a lot of things to a lot of people, but it really comes down to a couple core things, which is one, just around automation, which is just taking processes that were done by humans and then finding ways to automate them as fast as possible. Then you have the actual like machine learning, which is when you have large sets of data and then you pick up patterns from that. The machines or AI are able to do that at a faster rate than humans. So really it's just like taking a step back and saying like, hey, we have an opportunity to introduce automation and machine learning to then make our service more cost effective so that we can help people who normally have been ignored because they didn't have a quarter of $1 million.
Now, I understand by looking at your website, your AI platform has a name, or the person inside of it doing the stuff has a name. She goes by the name, or it, or whatever I'm supposed to say. Goes by.
It's okay.
Wait, it goes by Nia.
I say she too. Yeah.
It goes by Nia.
It goes by Nia.
Is her last name long?
Oh my God.
I don't think so.
No. Are you sure?
Maybe if she wants to come and do some promos for us, I'd be happy to have it. But I mean, no. I mean, so no, it's just.
So who is Nia? What does she do inside of the platform?
So Nia is just the name of our technology that's behind that. And so when someone is coming to our platform, they get a blend of where they can talk to humans like Malcolm's who are experts in this field, but in order to make this cost effective, we had to make something automated, and that process and that interface, or that person that they're talking to is Nia. That's who they get the emails from, the text chats from. That's their ongoing partner. So if you want to make it long, you can make it long, brother.
If my mind is Nia Long,
that's all right. That's all right.
That increases the fee.
Indeed. So let me ask you this: how do platforms like yours help people grow money for the future? Like, kind of take me through that you're thinking.
So the thing that makes us really unique, and we really focus on helping people build wealth, is that a lot of fintech platforms are very niche. Like, hey, I'm gonna use this app and then I'll buy stocks for free, right? But what if you have debt that way outscales what your investment is, right? So then what we do is that we look at people's holistic life, like their retirement at their job, their savings, their debt, and like we say like, hey, I know you came to us to get started investing, right? But based off of your, where you are right now,
your full picture.
Let's first get your emergency fund set up. Right? So, steps like that and really being their partner ongoing is how we help folk build wealth.
Okay, let me ask you this: what are the risks of robo-advising Nia taking my money and doing some algorithmic things?
Yep.
And who's responsible for the losses when if the platform loses? Like, let's say we are invested in Freeman Capital and it's managing everything fine, and another great recession hits. Who's responsible for it? What are the risks? And maybe Malcolm, you can speak to that as well.
Well, I'll say that one, that the great thing is that our customers always have control over their money. So it's not like a matter of them giving it to Freeman. So if things happen, they can always withdraw. There might be some consequences to doing so, but they always stay in control. Second is that the way that we build our plans is that we focus on helping folk have an emergency fund in case of any type of emergency, being responsible with their debt, and then when it comes to their investments, we love the upside potential, but we build plans based off of downside risk, because really that is where you make and lose your money. I mean, and so we try to skew a bit to the conservative side to make sure that our new investors have a good experience and they want to keep coming back. But that's kind of how we help folk out.
And then Malcolm, a little bit on like the industry side, who's responsible for losses when it happens inside of the construct of a automated advisory service?
You, the investor. All investments carry risk. Past performance is no promise of future results. All that good stuff that goes right under the bottom of every financial firm's website that tells you, like, don't invest if you don't know what you're doing.
Right.
Wait, no, that's me. It says something to the effect of at your own risk, I think is the way that it's explained. But the thing I wanted to make sure that I pointed out is that, so you asked me about where the industry is going and should I be concerned that the robots are coming? And one of the things that I think is the easiest thing for the robots to commoditize is the financial, the actual investment management.
Okay.
So right now, you pointed out Schwab, so I'll use their name. I usually try and stay away because I just bought a house and I don't want to get sued. But since we brought them up, I'll use them as the example. Schwab can manage your portfolio probably as good as any individual who's going to just buy you index funds and every once in a while rebalance the account and make sure that it's aligned with what you said you wanted to do. It's the plan and the actual steps you take in between that matter the most.
Okay.
So the way that I always tell clients to think about the investments is that's the vehicle that's going to drive us to the goal you told me you had, not really the thing we want to focus all our attention on. Because the investments, to your point, they can go up and they can go down. But if I've helped you figure out a way to save a few dollars on your taxes or helped you figure out a way to protect your family from an insurance perspective and stop overpaying for that whole life policy you got sold because you didn't know better at the time, but now you know better because you listened to our show, then I've actually earned my fee, irrespective of your investment performance.
Definitely. Now, Calvin, for you, how does Freeman Capital make its money from a business standpoint?
So we have a very simple model, right? So within our platform, we have financial planning, we have the automated investment management, and we have education, and you get all three of those unlimited for $20 per month.
Oh, wow. Okay.
And so we tried to create a pricing structure that would allow the masses to take advantage. I mean, one of our customers just said this. They said, basically, for the price of Netflix, you let me get my financial life together. And that's basically what we're trying to do.
Okay. So the financial advising landscape, as Malcolm kind of alluded to a little bit, is definitely shifting, especially with more fintech companies enter the space. What do you see as the next thing in fintech? You talked about first wave, second wave, third wave. What's the fourth wave, if there is a fourth wave coming that you can see?
Well, so I think that the fourth wave is still way out in the ocean. We are still at the part where we're just getting to the cusp of that third wave coming, because there are so many products out which are still only focused on those who are already wealthy. And so we haven't fully hit a peak in just bringing these services out to the masses. And so that's what we're trying to do. I mean, even just take this for example, within our investment management service there, we have fractional shares. Now that means that people don't have to buy the whole $2,000 Amazon stock that they can get started for $1 or whatever they have, right? And it's those types of offerings which are bringing the market in. And then the beautiful thing is that with a service like ours, people when they first get started, they can be a bit emotional. Oh, I made money today, I lost money today, I'll pull my money out. But with our service, we can then provide that extra layer of guidance and protection as we bring this out to the masses.
Okay. What problems can't fintech solutions solve?
So that's a really good question, because I think that the biggest problem is human behavior, right?
Yeah.
So like, the fintechs are guides. It's like,
You sound like a tech person saying the problem is the people. If we could just edit out the people, we'll be good.
But if you can solve taking the human emotion out of the investment equation, you have just solved $1 trillion problem.
Right.
exactly. And really that's it, because we will, be a guide with people. We'll send them messages. We'll have follow-up calls, all that type of stuff. But if you want to ball out every Friday at the bar, we can't stop that behavior, We can't stop you stunting on the gram. It's just, we'll do the best that we can, but the way that we're trying to at least augment it is by showing examples of people like you that have made changes and made it, and then providing education, because once you know better, most people then at least try and do better.
Absolutely, absolutely. Well, lastly, before we close, when can people and where can people expect the product to be available, and how can people get involved?
So it's at freemancapital.co, and we're actually going live and letting virtually everyone on starting in August of 2019. So it's right around the corner for us.
Okay, excellent. And if people want to learn more, they can visit you at
the website, freemancapital.co. And the great thing is that, at least for right now, and then this will extend into August, that the first 100 people that sign up can actually get in for cheaper, for just $10 per month. And so the sooner that you run to the site, the sooner that you can get it for the low.
Excellent, excellent. Well, Calvin, we appreciate you coming on the show and sharing a little bit about your
Appreciate you having me.
platform. Absolutely. And that will wrap up this episode of Manage Your Damn Money. I want to remind you that you can always catch past episodes on Apple Podcasts, SoundCloud, Stitcher, Google Play, Spotify, and anywhere else where you listen to podcasts. Please, please, please leave us a review on any of those platforms. That helps more people catch our show. And of course, if you have a question or you want us to cover a particular topic, send us your suggestion, info@manageyourdamnmoney.com. You can always catch us on Instagram. My handle's @MYDM1. Malcolm, what's yours?
@Malcolm on Money.
And because you're sitting here, what's yours, sir?
Freeman Capital.
All right, very good. And of course, you can always catch us on Facebook, facebook.com/Manage Your Damn Money. Thanks once again to our partners here at Montgomery Community Media for their hospitality. Until next time, be good with your money.
Peace.
Peace.